Welcome back to Behavioral Finance and FinTech. I'm Andy Kim, your Dr. Finance, and here in this video, I'm going to talk about why EMH is such an important thing for neoclassical economics. So I'm going to talk about it in 5 different perspectives. 1 is social planning. 2 is who wins and who loses in the investment. 3, risk sharing among investors. And 4 is about incentive giving in corporate governance. 5 is about resource allocation among divisions within a company. All right, so one by one, social planner's perspective. What the heck do you mean? Well, think about the communist government. They are trying to, right, centrally plan everything to ration the resources and food and everything for the people, right? Who do that rationing? The government, I said, but usually it's like an elite. They say elite. The Marxist idea was like, let's assume that there is a philosopher kind of a impartial elite who will altruistically divide everything for the people, right? Loving everybody, and then it's like that. So, but did that work nicely? No way. You know, after 70 years of testing in Soviet Union, it turned out to be totally bogus or completely fell down, right? Why is that the case? Because everybody is selfish anyway. Those central elites, don't be hypocritic over there, right? Hypocrisy. You see a lot of them as if they are not impartial, but behind the curtains, you know what they do, right? So, Adam Smith, right? 18th century economist in Scotland, right? He proposed this idea, right? You know, as long let their market participants behave as they are, so that they will fulfill their selfishness. You know, it's okay to the extent that everybody abides by the law, right? All the country has to do, or the government has to do, is to be a policeman, right? Just to be a police, so that these market participants will abide by the law, right? Within this framework, let there be market, and then they will trade, buy and sell to their own self-interest, and to that extent, there will be exchanges in the market, so that the invisible hand called the market mechanism or price, right, will, enable the resource allocation to the most efficient manner for the whole society, right, so that the maximum number of maximum utility, 최대다수의 최대 행복. It's like will be realized quite naturally thanks to the price mechanism. Hopefully that price mechanism will reflect that information, right? So what if that information is not reflected? Is a fundamental problem over here. Now you see why it's such an important issue over here. It gets back to Adam Smith, right? So if correct, prices give useful information about expected economic growth, discount rates, and volatility, i.e. risk, right? And then Pareto optimality will be, achieved, and resource allocation will be happening with the best efficient manner in the society. But if prices, right, doesn't incorporate the information correctly, bad prices compromise business and consumer planning, screw up the whole economy, is the issue. Social planner's perspective, everything gets screwed. And then, for that purpose, you look at for the central government, right, and then the central bank, and then the treasuries, as an economic, the government, right? When they look at how the economy is doing, right? Jerome Powell, kind of guys, when they set the interest rate to fight against inflation as well as unemployment, managing the whole country, they have to look at certain thermometer of the economy. What could be a good thermometer? Stock market. The stock market, they look at the stock market index, and then they can judge whether the economy is overheated or in a crash, not a crash, but let's say recession is ahead or boom is going on in a very efficient manner. Only if the price of the stock market correctly reflects the information, right? What if the stock price does not reflect the information correctly, then the stock index or this price stop working as a thermometer of the economy. Whole problem gets worse from the central government perspective or resource allocators perspective, right? And then the second point, who wins and who loses in investing matters together with this EMH. If prices are right, i.e. EMH holds, then average investors cannot really make mistake because everybody, as long as they stay diversified, and portfolio theory holds over here. Don't put all your eggs in one basket. Remember that? You diversify your portfolio, right? To the extent that you form a market portfolio, well diversified, perfectly diversified. So on average, you don't lose much, right? Higher risk will be compensated with higher expected return. So high risk, high return trade-off naturally happens with it. But if prices are not right? Can we really generate this kind of portfolios in a efficient manner? Price is not informative, right? And those return information that you got based on those screwed up prices, can you trust that one, right? Is really a big problem. Unsophisticated traders subsequently may lose money, right? Who don't understand the game of the name of the game, bubble game, right? Or more generally, irrational prices can arbitrarily affect allocation of wealth in the economy. Okay. Overall, the individual investors like you and me get screwed up much more than the institutional investors. The third point is about allocating risk across investors, risk sharing among investors. Remember, in your portfolio theory, what did you have? Well, efficient frontier. As you form a portfolio of different stocks, right? Two different stocks. Here, horizontal axis, you have portfolio risk, expected return of the portfolio. This one, 100% invested in, let's say, a Tesla. And that one, let's say ExxonMobil, right? And then if you 100% invested over here, 100% over there, and then as you form portfolios of these two stocks, the risk and the return profile shows not like this in a linear fashion, but like this in a curved fashion. Why? Because of the correlation. They are not perfectly correlated, but sometimes close to zero, sometimes even negative. It can happen, but like this, right? So what is good about it is that for the same degree of risk, right? For the same degree of risk, you can achieve higher return instead of this guy. With Tesla, you can expect it, have better return. With the same degree of expected return, right? You can achieve the same degree of expected return with lower risk. You hate risk. You are risk averse. So isn't it more efficient to be over here in this line? Okay? And then moreover, if you add more stocks over there, and then the umbrella becomes more expansive to a certain degree there, like this. And this to the converging point like this, right? Over here is what's called efficient frontier. Okay? Best maximum expected return that you can get for a given level of expected, a given level of risk, right? That's efficient frontier over here. And then what you can do is that you can construct another thing to consider is that you have a risk-free asset, which is zero, by definition, zero risk asset, RF, right? RF. And then what you can do is consider a tangent line between this risk-free asset and then efficient frontier. And that tangent point is something called market portfolio. I should say market portfolio. Okay? Efficient point, right? Efficient frontier, and that is the market point. Then we have a two-fund separation theorem. Okay, two-fund theorem. What does this tell us, right? Well, this guy is the perfectly diversified risky assets. Let's say S&P 500 or Kospi, Kosdaq, KRX index, everything included, or even your all kinds of real estate or risky assets all together. You can form the efficient market portfolio like that. So one fund is over here, right? Market index. You can think about it as market index ETF. That's there. And then here is a risk-free asset fund, right? Two fund is separated. Now, what can you do as a portfolio manager? Well, your clients may have different demand about, different risk preference, okay? Different risk preference. Well, if you go talk to anybody like grandpa, they hate to take risk, so they are a lot more risk averse. So if those clients are more risk averse, then you can let's say you are a private banker actually instead of fund manager, right? Private banker. Well, you can listen to their voice and say, if you are risk averse, well, give me a risk level that you can tolerate. I can give you the maximum expected return that you can achieve. It's not an expected, it is an expected return, not a guaranteed return, but to the extent it is expected ones, I can tell you some maximum of it using this capital market line. And then if you are a less risk-averse person or risk-seeking person, then you may end up in 100% market portfolio weighted over here. Tell me your risk preference. I can give you the expected return that you want to achieve with this market portfolio and then this risk-free asset. I just want to adjust those weight between these two guys, weight and 1 minus weight, okay? And then you can go in between. Where do you stand? Risk sharing, okay? Low risk tolerant guys, more risk tolerant guys, more risk averse guys, less risk averse guys, or even more risk loving guys. Oh, give me more risk. I want to achieve maximum return. P2, it's like a leveraged position. You borrow more and then place it on the market portfolio so that you can achieve higher expected return with higher risk, right? In a portfolio level, you can construct this and then listening to the risk preference of all different investors. We call it risk sharing among these investors. All this kind of framework is possible only if the market is efficient, so that the information is correctly reflected in those stocks and returns, so that you have correct information about this risk and return. Remember, this risk and return is based on the price, and then the risk is based on this return in turn, right? So that's why if the efficient market is broken down, all these kind of things get screwed up. So that's a problem. The fourth point is about corporate governance. EMH matters in corporate governance as well. Why? Corporate governance, first of all, what is that about? It's about how to get my precious money back as a shareholders. If, all these kind of things, principal agent problem, right? Agency problem or principal agent problem, does not happen if the ownership and control is the same. Okay, there's no separation. For example, if I have a company, mom and pop store, that I am 100% owner of my store, right? There's no governance issue, no principal agent problem, because I am myself, right? And if I do a lazy work and I screw up my business, I get unhappy, okay? But as soon as I delegate my company's control to somebody else, right? Hire somebody as a CEO and then tell them, you do this one when I'm not, I cannot observe or I cannot monitor you, right? Do it with your own best effort. So please work hard. And then I do something else and he or she works for my company. Then the governance issue comes in. The principal, myself, and the agent, the CEO, right? Different people. The thing is, the CEO wants to maximize what? His or her utility. Okay, CEO wants to maximize his or her utility. Shareholder B, I want this guy to maximize what? My shareholder wealth. So utility maximization of that person, and then shareholder value maximization for myself, right? How can we make these two things get aligned, right? Usually they are not aligned. And you never know what's gonna do, what this CEO is gonna do behind the closed doors, right? Smoking a crack or whatever, sleeping or doing nothing. Who knows? So how can we make this, resolve this principal agent problem by giving economic incentive, right? If you want to impress any economist or professors, spit out a word incentive immediately, and then the professors will be like, "Oh, he's smart or she's smart," right? Now, incentive. Now, what kind of incentive would you give, right? Given that you are a publicly listed company, right? What you will do is give some shares, the stock ownership, and call option. Why? Because you want to align the interests together in a way that the CEO now becomes one of the shareholders. Become one of us, and then think like one of us, so that you maximize the shareholder value, and then your compensation gets higher, and you maximize your utility in that way, right? So 누이 좋고 매부 좋고 in Korean terminology, and everybody's happy. You happy, me happy, right? What's the big assumption behind it? Well, the assumption is that the information that the CEO is working hard and smart gets priced immediately, right? If the price is not informative, if the market is not efficient, then the whole incentive scheme breaks down. Why? Imagine you are the CEO and then you got the stock ownership from the shareholders, but the share prices are always in sky high, regardless of whether you are screwing up your daily businesses or really working hard, or it doesn't matter. 너나 공부하나 마찬가지라. It's like whether you study hard or not, you get the same point. Would you ever study hard? That's the same idea. Okay. If the stock is in the bubble, nobody will try to work hard, right? All they think about is when can I sell the stock? Instead of working hard. So no incentive effect. Bubble. Market efficiency versus bubble. This is a critical issue when it comes to this corporate governance. So that's why. Okay. The case of KD Media is the same thing. In Gangnam Style 2012, they were one of the theme stocks, bubble stocks related to Psy, right? Gangnam Style, that the company once made the album jacket a long time before. But with the Gangnam Style bubble taken up, their stock price went up by 3 times or something, so that all the employees over there, they were watching the screens too much instead of working hard. So the CEO complained, "Oh my God, Andy, you know what? They are not, how can we incentivize these guys to work harder?" That's a tough, situation. So if I were them, I would not link the compensation to the options or ownership. Instead, I would link the compensation to ROA or accounting numbers in that kind of situation. Anyway, for the stock ownership and the options to work as the incentive mechanism, the market has to be efficient. Number 4, that's the key point. And then number 5 is allocation of capital across firms or within divisions, different divisions, right? Tobin's Q, I'm going to talk about this a little later. Allocation of resources. What the heck are you talking about? I'm talking about this Hyundai Motors, right? I'm sorry, the 의선 형, right? 의선 Brothers face, I'm just happy, I didn't mean to, but the CEO of Hyundai Motors, right? Every year, right, they will have to think about how to allocate their budget, the limited budget, to different divisions, right? I know the Hyundai Motor is a huge corporation. We believe that they have no worry about those money or anything. But in the end, the money is a scarce resource anyway. And then economics is about how to allocate this scarce resource in most efficient manner. And those divisions, Hyundai Motors must have many divisions, like for example, combustion engine, 내연기관, and then electric vehicle, EV divisions, and hydrogen vehicles, right? And then others, right? Then every year, at the end of every year, these division heads will get together and fight like crazy for their own budget. Give me more money, not you, get away from me. And then 의선 brother, please give me more money for our budget. Why? Because they have their own subordinates, and then their political lines, and then they have their own self-interest over there, right? They are fighting for that money. Now, Of course, they have their own reason to succeed in their own industry. Now, for 의선이 형's perspective, the CEO's perspective, what would he care about? Okay, what would he care about? He wants to allocate the money to what? To whom? The one he likes most? The personally? No, he has to be impartial, but he has to be allocating money in a most economically efficient manner. Then how? Well, by looking at Tobin's Q or PBR kind of things, PB ratio kind of things. What does PB ratio tell us? Well, PB ratio is about market cap, price, market cap, which is market value of equity, divided by book value of equity. So for each dollar of equity those shareholders invested historically, for each dollar of equity investment done before, how much is it evaluated in the market right now, today? PBR tells that story. So given that you invested $1 in combustion engine, how much would you want to be evaluated in the market? At least more than 1, I guess. If that happens, the PBR will be bigger than 1. But right now it's about 0.5, which means $1 invested, only worth 50 cents. Why did I ever invest it? In this kind of situation, what would you do? Pull out that business, right? Lay off a lot of people and then restructure it. Then allocate that into the resources into what? More promising businesses like electric vehicles, right? Look at Tesla's PBR. How much is that? How big is it? 5, I guess, right? For each dollar invested, investors in the market evaluate it to be more like $5 or something. So invested more over there, right? Reallocating and restructure your divisions, right? Tobin's Q is a better alternative than PBR, right? PBR was looking at only the equity side of the equity part of the balance sheet. Tobin's Q looks at the asset side of the balance sheet, right? Asset. For each dollar of asset that was invested previously, okay, historically, how much does the market evaluate today? You want it to be bigger than $1, right? Bigger than 1 times, right? So that's the Tobin's Q idea. And then allocate your budget to the divisions with the highest, the proportion to the Tobin's Q number, right? So that's the most efficient way of allocating the resources. But there was an assumption that the market cap or the market value that goes into the numerator is correctly evaluating all the information, correctly reflecting all the information in the market, right? What if market is not efficient so that the price in the numerator is screwed up, somehow is too much inflated? For example, the Nikola that you see on the screen over there, right? Nikola, hydrogen, not the hydrogen bomb, but hydrogen truck. That was a total fraud, right? But the market evaluated in a bubble manner so that the PB ratio of the hydrogen, truck business shot up to 10 times or more. Then 의선이 형 will misunderstand. I was like, oh my god, 수소차 is so sexy, so let's allocate all our budget to a hydrogen car instead of electric vehicle. That's a natural way of screwing up the business. So you don't want to happen that, or you don't want that to happen, right? For that purpose, the price has to be efficiently reflecting all the information related to it. So that's very important, right? So that's the story over here. So next video, I'm going to talk about theoretical underpinnings of EMH. So thanks for watching.